Rob's Child, No Investment Advice. Welcome back to the series where we go over every chapter of Benjamin Graham's The Intelligent Investor, revised edition from 1972. Again, this series has no intention to replace any content of the book, but rather to open it up for discussion. Feel free to use the comment section below to discuss any topics. This series is also intended to bring the subjects of The Intelligent Investor up to date as of the end of 2024, and also to add commentary that relates to Benjamin Graham's original work, Security Analysis, second edition, the much harder, longer biblical version of how to be an intelligent investor. This episode covers the final chapter of the book, Chapter 20, Margin of Safety as the Central Concept of Investment. Overall, this chapter doesn't really go over any new concepts. It kind of just wraps it all together and tries to get the reader to be confident in this methodology. One final, note I want to bring up, being in this last chapter, is that, with security, that's one big thing that I learned about security analysis is that, the hundreds of examples that he walks you through is not to teach you new things. It's to hammer in the fact that, he's right, and that, value investing, his way of investing, it's based on math. It's not based on hope. It's not based on crystal ball gazing or the stars. This is essentially boiling down to arithmetic, as he says beautifully at the end of the chapter. So let's begin. We start the chapter. He writes in all caps, margin of safety, emphasizing that this is what his work is really all about. As he says explicitly in Security Analysis, a long way of discussing it, the best chance that anybody has is doing the whole margin of safety way of investing, because while you can't control what's going to happen to the price of something in the future, the one thing you can control is figuring out something that is obviously at a price that is below its value, its apparent value, and just hope that the market eventually wakes up to that fact. Even if the market doesn't wake up to that fact, that's really the best chance you have at having true safety and satisfactory results in return. And that's what this is all about. So we'll go through the points. So 5 times before tax interest charges for safe railroad bonds. This is, with some of the biggest corporations that have, AA corporate ratings, you want to see the EBIT, EBIT, be 5 times the interest payment at least. And we see that today across, AA credit rated companies. I'll add to this really quick that there seems to be a lot of industries today where it's so competitive that, you don't expect or need to have that much coverage of interest charges, and a lot of, types of businesses, like grocery stores is one that always comes up, because the expectation of being able to generate very consistent profits, since everyone always eats, you're not exactly going to have very often a downturn so severe that people will stop eating. I mean, this is a quick example, but anyway, having your railroad bonds covered by 5 times guards against future bad developments. So if they lose income for a year, it's okay, because they have plenty of safety, plenty of margin of safety in that case. Then we have a quote: "The bond investor does not expect future average earnings to work out the same as in the past. If he were sure of that, the margin demand might be small. And that relates to my, grocery store example. And, arguably there's like a lot of businesses that operate that way with not having very great coverage of their interest payments, especially today in 2024. And then he goes over basically debt to equity ratio. This is something that people often bring up in comments of my videos, especially when I bring up Nissan stock. And yeah, in a lot of cases, when the equity is below the debt, it means that the bondholders will suffer a loss. But in Nissan's case, the way that I interpret the balance sheet and everything, by the way, is that the earnings fully cover everything. The company is in like really great financial health. I don't fully understand why the stock price is so suppressed. But anyway, moving on, we have a quote: "Since average stock prices are generally related to average earnings power, generally speaking, the margin of enterprising value over debt and the margin of earnings over charges will in most cases yield similar results." And like I said in my note here, this is not always completely accurate because I've seen market caps below the debt, but the earnings cover the interest payments very well. Especially, and it's not just Nissan. Lots of car manufacturers are trading at very low PE ratios. I like Nissan in particular because its balance sheet is pretty rich compared to most other car companies actually right now. But anyway, moving on. He's moving on to stock margin of safety. So we've covered, okay, for a bond to have a margin of safety, assuming, and we're talking about buying it at par, you pay $100 for the bond and it's paying the coupon, and not necessarily at a discount. This is just for normal operations here for having the margin of safety in that way. But then, so now we're talking about, well, how does that go and equate into a stock margin of safety? And we have a quote here. For example, when a company has outstanding only common that under depression conditions is selling for less than the amount of bonds that could safely be issued against its property and earning power. And this is what I'm talking about with the Nissan stock. I think it's fully covered. But anyway, there's a lot of quotes from this chapter that I bring up because there's a lot of really good ones. Again, if you really want to understand all of this stuff better, more deeply, this book, in The Intelligent Investor, it gets you to understand a lot of things pretty well, but it's the security analysis. You really have to take the journey if you really want to get this stuff more clearly. And even if you do get through this book, a lot of it will probably go over your head the first time, as some of the concepts in it went over my head. And so I do plan on going through it again myself in the near future. But anyway, we're going to move on. We have another quote here. "In such instances, the investor can obtain the margin of safety associated with a bond, plus all the chances of a larger income and principal appreciation inherent in a common stock." So again, we're talking about the bargain issue where the stock is clearly worth more than what it's selling for based on the fact that it's earning plenty of money, and there's, has plenty of book value, etc., etc. All right, moving on. Ordinary stock for investment. The safety is expected in the earning power to be considerably above the going rate for bonds. And so, anyway, he walks through an example from a previous book, and I wanted to note here that earning power, when he says earning power, he's talking about earnings before interest and taxes, not the earnings number that you normally see with PE ratios. The PE comes from the margin. That's what he's talking about. The earnings is the margin. That's how he defines it. So the conclusion is that the margin should be above the bond rate. And my note here is that this is why there's that differential that we discussed in, I don't remember which chapter, it was an earlier chapter, regarding the, comparing PE ratios to bond yields. As he said, like us earlier, if you remember, if you have a if the double A bond standard yield, for example, is 5%, that's the equivalent of the stock selling for a PE ratio of 20. That's like things are equal. And what he's saying here, I said there's no new concepts in here, but it sort of is. So what he's saying here is that he actually wants the earnings to be higher than the bonded, than that bond percent ratio. And in this case, it's 4%. It's the earnings is basically 9, and 4 of it of the EBIT goes to the bonded debt, and there's 5 left over for the stockholder. And I believe in that case that would be the equivalent of a PE ratio of 25, if I'm not, 20, a PE ratio of 20 with a 4% double A bond. Yeah, like I said, 5 times 20 is 100. Yeah, all right. Anyway, moving on. We got to get through this. We have another quote. Over a 10-year period, the typical excess of stock earning power over bond interest may aggregate 50% of the price paid. This figure is sufficient to provide a very real margin of safety, which under favorable conditions will prevent or minimize loss. And then moving on, there's a footnote that mentions a speech, actually, where Graham discusses in 1972, the same year this book, this revised edition came out, that there is a negative margin of safety in that year in stocks because of there being a discrepancy between bond yields and earnings. And besides the footnote, the book is basically saying this same thing. I'm going to point out that if you watch my daily shows at all, as of the end of November in 2024, I talk ad nauseum about there being a discrepancy between the PE ratio of the S&P 500 and current bond yields, not just double A bonds. Just look at the Treasury, bond rates being over 4%, while the PE ratio of the S&P 500 is 30 or 31 right now. Graham would describe today stocks having not just a negative margin of safety, but a severe negative margin of safety. He would definitely see stock prices as being very problematic today in 2024. Anyway, moving on, he mentions that the problem of fixed income versus inflation, along with PE ratios being too high. And he concludes, as of the writing of this book, and I quote, "Good profit possibilities combined with small ultimate risk is no longer available to him." And so, he's basically complaining the fact that there's no way to win when stocks are overly expensive, and you have to consider the fact that there's inflation going on. You don't have a way to safely invest and get a good return. He's saying it explicitly. It's again, I'll say it again because this is an important point to make. That was going on at that time. Good profit possibilities combined with small ultimate risk is no longer available to him. Now, while I say the S&P 500 today in 2024 is overvalued, there are certainly areas that are very clearly undervalued and would be very attractive by Graham's standards. And in security analysis, he mentions, don't worry too much about political risk. This is, again, why I myself am invested. I have a lot of Brazilian equities and Chinese equities because of the very clear margin of safety that I see with the valuations of their entire stock indices actually right now. I'll add to that there may be a near future period where maybe all stocks, including those stocks, get to the point where everything is overvalued, and then yeah, what do you do? What do you do? Anyway, moving on, we have another quote. Observation over many years has taught us that the chief losses to investors come from the purchase of low quality securities at times of favorable business conditions. As he said earlier in the book and in security analysis, when times are good, you have everyone and their brother going out there and selling stock of, shell companies, .com companies. Oh yeah, I own greentree.com, and it's $1 billion business, and everybody buys the stock because things are good and they're low quality and people buy into them, and the chief losses to investors come from that, buying really bad stuff when things are seem really good. When things go south and things get bad, that's when the most amount of people get hurt the most. And yeah, people are lured into low quality securities massively in good, favorable business conditions. My note I wanted to add here, it says, similar to security analysis, when things get bad, underpriced stocks will can also become more underpriced. So that's also a little different. I'm referring to simply things being underpriced, even if it has decent quality and for whatever reason the market's not preferring that industry or that stock. Nissan. Anyway, I digress. Next point. We have a quote. It is in those years that bonds and preferred stocks of inferior grade can be sold to the public at price around par because they carry little higher income return or a deceptively attractive conversion privilege. He's talking about convertibles. You remember that whole chapter. It is then also that common stocks of obscure companies can be floated at prices far above the tangible investment on the strength of 2 or 3 years of excellent growth. So we're talking about bonds and preferred, basically with, no credit spread. If you've been watching my daily show, you know how crazy I'm getting about how tight credit spreads are getting, that junk bonds are only yielding, as of today, something like 2.6% above the Treasury bond rate, which is very rare. And it's literally happening right now. People are getting lured into lower grade credit bonds at higher prices, only just to squeeze a little bit more yield, getting pushed into these things. Common stock of obscure companies floated at price above the tangible investment. Think GameStop comes to mind, especially thinking about that. Just look at, even all of like ARK investments, for example, having the valuation of all of those stocks just going to the absolute moon, and then, retreating back down to much lower pre-COVID levels. It caught a lot of investors off guard. Anyway, moving on, and I quote here, these securities do not offer them adequate margin of safety in any admissible sense of the term. All right, next point, he mentions that growth stocks can be priced using future expected earnings, but are often not priced on conservative expectations of earnings growth. I bring this up as well in many of my shows. This is obviously a big part of security analysis. How many, I say all the time, for example, even Nvidia, one of the biggest companies in the world right now, is trading at a multiple that assumes that its earnings are going to, that they are already basically triple of what they are right now. And there's that enormous amount of speculative value priced into this growth stock. That's not And that's typical of growth stocks. When something they grow their earnings by 10-15% every quarter, nobody knows when it's going to end. But when it does, things get really bad, which is why it's so important to not get caught up, to not follow the crowd into paying prices that assume very high growth going into the future. Conservative expectations of earnings growth is the way that it should be done, not outlandish expectations of earnings growth. And we're seeing outlandish expectations of earnings growth being priced into stocks right now. And this is why I have been saying on all my daily shows lately that it's such a dangerous market out there. Moving on. We have a quote. It is a basic rule of prudent investment that all estimates, when they differ from past performance, must err at slightly on the side of understatement. Again, be conservative. If you assume, calculate the worst possible scenario, and if it still seems cheap compared to the worst possible scenario, that's a time to be smart and get yourself an advantage. Anyway, moving on. For growth stocks, the margin of safety is always dependent on the price paid. This is one also criticism I have of Warren Buffett and Charlie Munger, who, on one side of they talk out of two sides of their mouth. Sometimes they say one thing, but they're really doing and thinking other things. One of my pet peeves that they always say, I don't know why they do it. They say, "Oh, we don't care about the price. We just want to buy good businesses." Yeah, and what are they doing? They're the largest shareholders of some of these, good businesses, and they don't want the share prices to drop. Of course, they have to sell. They're peddling stocks, really. That's what a stock peddler is, and they're actually a lot smarter than that. If you recently, I think it was Berkshire Hathaway, recently sold like half of its Apple shares, and apparently, as of a few days ago, it sounds like they sold another 25% of it. The price actually does matter. It does matter. It matters a lot, not a little. The price is everything. We'll jump back to that point at the end of the episode. We have another quote here. If, as we suggest, the average market level of most growth stocks is too high to provide an adequate margin of safety for the buyer, then a simple technique of diversified buying in this field may not work out satisfactorily. And so this is just emphasizing the fact that, you can go into the index fund, you can buy the Russell 2000, but, if the whole market is too high, you're not doing yourself a favor necessarily, because you're putting your capital at higher risk. I say this all the time, and it's one of the hardest lessons to learn, is that when the price of something goes up, you're adding risk. The risk becomes higher the higher the price goes. Unfortunately, most investors, when the price of what they have is going higher, they think that it's safer, and they say, "Oh, it just keeps going up, therefore it's safe, therefore it will keep going up." That's not how it works. The higher it goes, especially in relation to its earnings or its earnings power or its underlying value or its book value, the more dangerous it gets to own that, because if it gets back down to a regular value, then you're losing that entire added value. And then on the other hand, when stocks get abnormally or insanely cheap, or certain bonds, junk bonds get crazily cheap, nobody wants them, those are the moments everyone says every single cycle that they're unsafe, they're bad investments, no one should own them, they're trash, and people just sell them at any price, unfortunately, at large losses. This is why intelligent investors are looking around and saying, well, what do you mean you don't want that for that price? Like, obviously there's a huge amount of safety here because it's obviously worth more than what you're selling it for. It's very, very difficult to really understand that lesson, but it's paramount for investing success. But anyway, moving on. With bargain issues, even a moderate decline of earnings can still make a good deal. In other words, if something's already insanely cheap, what ends up happening is that if the company shows like a decline in earnings, well, it's already so cheap that it doesn't end up going much cheaper because maybe it can't get much cheaper. Say it's a stock that literally got down to 1 cent. Well, I guess no, some stocks have even gone below 1 cent. You can have partial cents, but I think you understand the point. It can still be a good deal, even if earnings decline, if the bargain is good enough. And then on the flip side that I want to add to that, it's similar to a point that he's made before, similar to a slight decline of earnings in a very expensive growth stock, leading to the collapse of the price to a huge degree. When people expect the earnings growth, the earnings growth was 10%, and then it was 12%, and then it was 15%, and then it was 20%. So this time it's going to be 25 or 30%, and it ends up being 3%. Well, then, your stock price that already assumed that earnings were going to triple over the next 3-5 years, all of a sudden that picture's not looking so peachy. If we're looking at earnings decline, then the stock price in that situation can drop by an enormous amount. 90%, and it can still not be it can still be considered overvalued even after dropping a huge amount, depending on, based on the fact there was already so much speculative value pumped into that stock. NVIDIA, I'm looking at you. Anyway, I digress. We're moving on. The next subtitle, Theory of Diversification. Even with a margin in the investor's favor, an individual security may work out badly. Hence, diversify. Just because you're right, just because you're buying something that's clearly worth more, what can happen in some situations is you hold it at that undervalued price until the company actually becomes worth less than that value, and that's where you can lose out. But those it doesn't tend to work out that way in most cases, but it will in some cases, and that's why you never go all in onto one thing. He suggests, I think, somewhere your typical investor should aim for something between 15 and 20 stocks. Trying to manage or keep track of more than that is too much work, and less than that is not enough diversification, as you probably know from earlier in the book, if you remember. Anyway, we have a section where he talks about the game roulette. Not the American version. This is a slightly different wheel I think they used back then. He says that roulette has a negative margin of safety. Just to understand, this is to understand what is a margin of safety. What are we talking about here? He says that, you get a 35 times reward. He says $35 when you have a 1 in 37 chance of winning. So no matter what, the odds are stacked against you. If you played 1,000,000 times, you would lose over that time because your margin of safety is negative. And then he illustrates, well, what if the reward was 39 times and you still had a 1 in 37 chance of winning? Well, in that case, you'd have your positive margin of safety. And then you can just keep playing the game, and over time you'll just keep making money, or put $1 on every single number every game, because it costs $37 to cover all of the spaces, and you're getting a $39 reward each time. You make a guaranteed $2 profit every game. So that's the point of the margin of safety. You're trying to rig the game so you're guaranteeing yourself to win. That's what the margin of safety game is all about. Anyway, moving on, we have subtitle, A Criterion of Investment versus Speculation. And he basically complains that, out there in the world, there doesn't seem to be any single definition of investment versus speculation. And he says that this skepticism is unnecessary and harmful. He's saying, no, there is a proper definition of investment, and it's all about margin of safety. And that's all there is to it. Margin of safety, he suggests, quote, may be used to advantage as the touchstone to distinguish an investment operation from a speculative one. Arithmetic. Crunch the numbers. Figure it out. Moving on, he mentions, he discusses how market timing doesn't give a margin of safety. What he's talking mostly about here is that, you can't reliably predict that the market will keep that it'll stop going up or that it'll stop going down. You just don't know. All you can do is try to get yourself the margin of safety and in the ways that he suggests. He also says, and he quotes here, no guarantee that margin of safety will continue to show favorable results. So he's admitting, okay, there's no guarantee of anything in life, but there's also no valid reason for pessimism of this method because it's always worked and it makes logical sense and it makes mathematical sense. At the end of the day, it's really all about math. And then next one, we have subtitle, extension of the concept of investment, a discussion on conventional versus unconventional investments. And he says how conventional investments are appropriate for the typical portfolio, that being bonds and stocks at reasonable prices. Not at really expensive prices, at reasonable or, slightly discounted prices. You can get yourself a perfectly fine portfolio that works perfectly fine for most people. I'm going to throw in right here that the S&P 500 has kind of lost this ability. Even Charlie Munger, I believe, came out recently discussing how he didn't think he'd live to see the day where index funds actually got to the point where they're not doing people a favor. And when the entire S&P 500 index is at a PE ratio of 31, that's exactly what he's talking about. It's one of the dangers of passive investing, and it has to do with mass. It has to do with the number of people trying to do the same thing. When you have too many people taking the same approach to investment, it doesn't end up working out for everybody. One way to look at it is everybody being on one side of the boat and it sinks. Another way to look at it is, the whole idea that he discusses in the security analysis. If everybody adopts the same exact strategy, then the potential gains moving forward in the future, the advantages that you can get using that method diminish further and further until they can disappear entirely. And we might be there in terms of how wonderful index funds have become, but honestly, we might be on the other side of that now in 2024 with them becoming actually further in. We're going towards more inefficiency. When you buy VU, when you buy SPY, a bunch of that money is going into NVIDIA and some other companies that are clearly at much higher prices than they should be already. And these are funds that, managers are controlling, that, people's workplaces, governments that use money managers themselves are passively investing this money into these things that are very dangerous. They're passively investing enormous amounts of money into very dangerous things at this time in 2024, unfortunately. And it's going to hurt a lot of people moving forward, in my strong estimation. But I digress. Moving forward, the unconventional Remember, to get back on topic, we're talking about conventional versus unconventional investments. The unconventional investments are only for the enterprising investor, including, and I quote, undervalued common stocks of secondary companies, which we recommend for purchase when they can be bought at 2/3 or less of their indicated value. If you remember from earlier in the book, and like I've talked about, the magic number for Graham is 30%. If you got your 30% return, boom, get out. You got yourself a great deal. Be happy with it. Be done with it. And yeah, so the easiest way to do that is to just make sure you're buying stuff at, 33, a third discount. And then the other unconventional way of for the enterprising investor, he says that often there is a wide choice of medium grade bonds and preferred shares at an obvious discount. As of right now, the end of November 2024, that's not so true. Unfortunately, we're in a situation where credit spreads have gotten so tight that it's a great time to sell corporate bonds right now. I wouldn't want to be buying them right now. Really scary stuff out there going on in the markets. But again, I digress. Moving on, we have a quote: if the price is low enough to create a substantial margin of safety, the security thereby meets our criterion for investment. And I wrote, holy mackerel, triple star. And I can't believe that this is in here, that this is, and I didn't realize that this is part of the 1920s bubble, but I'll just read the quote to start. So, and I quote, real estate bonds. In the 1920s, billions of dollars worth of these issues were sold at par and widely recommended as sound investments. A large proportion had so little margin of value over debt as to be, in fact, highly speculative in character. My note, this is exactly what happened in the great financial crisis of 2008. If you had been a big fan of Benjamin Graham before 2008, that's how Michael Burry became famous. That's how he was able to do it. All he did was recognize that there were bonds being sold at investment grade prices without investment grade credit, without they had much higher risk than what they were being sold for, and it blew up the whole thing. It's amazing how that can happen in 2008 when this happened in the 1920s. And literally, this is a quote from the 1972 edition stating it explicitly. This is why so many people still today attribute, Ben Graham's the guy. He knows how this works, and apparently the world never learns. And apparently we're probably in the future going to have 10 more financial crises where people are buying bonds at par value. I mean, right now, like I'm saying, credit spreads between junk bonds and treasuries are extremely tight, and it's like the same thing. It's the same thing, and it's gonna blow up in people's faces, and there's gonna be a rug pull, and a lot of people are gonna get hurt and not understand what's going on, and it's really sad. But anyway, that's where we are in 2024. But I find this absolutely amazing that this could literally be taken from a news article from 2008. Unbelievable. Anyway, moving on, the price collapsed of many of these bonds to 10 cents on the dollar. So you had a dollar bond. It got to the point where people would only offer you 10 cents for it. Then they were considered to be trash by the same people. So the same people that were saying, oh yeah, these are safe investments, and saying them and selling them, he's saying that those same exact people at that time were saying, oh, you got to get rid of them, they're all trash. Even though Graham says at that point, when they got to 10 cents, well, they clearly had more value. Not, they're not 10 cents. Like, they're at least 50 cents. And so if you were buying these up from people thinking they're garbage because, they couldn't find somebody to buy them, you could have someone like Ben Graham running around and being like, yeah, sure, 10 cents, collecting a massive amount of them. And then when the market wakes up and is like, oh, these things actually pay that much? What? Oh, they're clearly worth more than 10 cents. That's what value investing is all about. Anyway, and there's lots of safety in something that has such a discount that, again, we're not even asking for it to return to its par value of $1. We're asking only for 50 cents, from 10 cents to 50 cents. Beautiful. We have an excellent footnote here next that I wanted to bring up, and I quote, Graham is saying that there is no such thing as a good or bad stock. There are only cheap stocks and expensive stocks. Even the best company becomes a sell when its stock price goes too high, while the worst company is worth buying if its stock goes low enough. I love that quote. It just emphasizes the fact that, beyond people's perceptions and opinions about businesses, politics, whatever it is, this is about math. This is a game. This is a computer game that involves math. Unfortunately, most people don't realize that, and they don't play the game that way. But anyway, moving on, he mentions, again, special situation operations. He's referring to, of course, largely arbitrage situations, obviously. Then he goes on to suggest an extreme theoretical example of warrants. And, remember that entire chapter where he's complaining about how crazy out of hand warrants have gotten and how he hates them, just like he talks about how much he hates preferred shares. But if the price is low enough, all of a sudden, being so low in price that they could serve as not just a speculation, but actually a defensive investment. And he's choosing his words carefully, and he's trying to be shocking. He's trying to shock you, saying that, Ben Graham, the value guy, is calling warrants in certain situations to be a defensive investment. So the point is, he basically is saying, just do the math. If the reward outweighs the risk, then do it. I'll bring up an even more extreme example of this regarding actually lottery tickets. Every time somebody doesn't win the Powerball or the Mega Millions and the pool gets bigger, the chances of winning versus the reward amount. If the reward becomes big enough, it sounds silly to suggest this, but you could consider a lottery ticket to be an investment, considering that the reward outweighs the actual risk that you're taking. And I think I tried to calculate it out once. I think once the lottery gets above, I think it's 200 million, then the chances that's when the reward outweighs the risk actually taken by buying a ticket. It's kind of silly because it's like, well, in a way it really is like throwing your money out the window, but at the same time the odds end up start to get stacked more towards your favor in terms of risk versus reward. And that's the point of that. Anyway, moving on, we have a quote: a sufficiently enterprising investor could then include an option warrant operation in his miscellany of unconventional investments. So even Ben Graham, the value investor, says, yay, you can even do warrants if the reward versus the risk makes sense. Then we have the final subtitle of the book. To sum up, stocks are business ownership. Don't forget it. And owning a business is business itself. When you're a stock buyer, you are involved with a business interaction. That is, you're running your own business by buying and selling your own securities. And it's important to realize that the things that you're dealing with are business items. They're business securities. They're the debt and ownership of companies. And then also you are conducting your own business by doing that. And so he says, in a quote here, know what you're doing, know your business. Another quote, do not try to make business profits. He has the 4 rules here, so I think this might be the first rule. Do not try to make business profits out of securities, that is, returns in excess of normal interest and dividend income, unless you know as much about security values as you would need to know about the value of merchandise that you proposed to manufacture or deal in. So he's saying, yeah, just know and understand what you're doing. Don't go in blind buying, the next hot stock because you think it's going to keep going up in value, or your neighbor said, hey, this stock looks good, or even on my videos, don't buy a stock because I said it's good. Understand the details yourself. Dive into the numbers. It's when you're doing business, it's your business, not anyone else's. And he says that's the next point. Do not let anyone else run your business unless, number 1, you can supervise his performance with adequate care and comprehension, or number 2, you have unusually strong reason for placing implicit confidence in his integrity and ability. This is why you don't take advice from Robschildseer investing advice. Do your own homework. I do what I think is right. I say what I think is accurate about what's going on with the pricing of securities, and it's your responsibility 100% to make your own choices. Anyway, moving on. Do not enter upon an operation that is manufacturing or trading in an item unless a reliable calculation shows that it has a fair chance to yield a reasonable profit. In particular, keep away from ventures in which you have little to gain and much to lose. I'm going to boil that down to don't buy stuff that seems like it might be expensive. So then you automatically have a lot to lose. And if it's expensive, you don't have that much to necessarily gain. You're just hoping that, it'll go up in price. And unfortunately, that's how most people conduct their investing operations, from what I can tell out there. Momentum traders and the like. Anyway, his operations for profit should be based not on optimism, but arithmetic. That's the key word. And then we move on to the 4th business rule, and I quote, have the courage of your knowledge and experience. If you have formed a conclusion from the facts, and if you know your judgment is sound, act on it, even though others may hesitate or differ. And I quote as well, you are neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right. And I quote again, courage becomes the supreme virtue after adequate knowledge and attested judgment are at hand. So do your darn homework and believe in it. And, just shut out the crowds, shut out what other people say, do your homework, figure out what you believe, with, what may happen with your investment, your own investment policies. One thing I like to add to this is always assume that you're going to be wrong, that you're completely wrong about your ideas, and know that, and be okay with that. You need to, beforehand, be okay with being wrong before you even make the decision to buy or sell an investment. That's an important psychological thing I think investors really need to have. But anyway, moving on, the last point for the typical investor, the last point of the book. For the typical investor, it's easier than it looks to get satisfactory results. I'm going to say again, in today's day and age in 2024, for how stocks are priced right now, it's probably harder than it looks to get satisfactory results from today, specifically today, the end of November 2024. But anyway, He also says, and harder than it looks to get superior results. While your neighbor's cousin, became a millionaire on Bitcoin, and therefore you want to buy Bitcoin now at $100,000. Well, it's easy to get superior results. Just throw it into Bitcoin. What can possibly go wrong? Last note I want to bring up, in the PDF file, you scroll through after Jason Zweig's final commentary, there's a postscript written, and I just wanted to quote the very last sentence of the postscript. And I quote, "Interesting possibilities around the financial scene, and the intelligent and enterprising investor should be able to find both enjoyment and profits in this three-ring circus. Excitement is guaranteed." And that concludes the last chapter, the final chapter of Benjamin Graham's revised edition of The Intelligent Investor, Chapter 20, The Margin of Safety as the Central Concept of Investment. Hope you enjoyed. Thank you for watching, and see you next time. Rob's Child.